Welcome back to another explainer. You know, if the macroeconomic data from May 2026 has proven anything, it's that the era of transient inflation and basically free money, yeah, that is definitively, undeniably over. We are watching a massive, highly volatile realignment of the entire global economy unfold right before our eyes. It is, quite literally, a perfect storm. We've got a violent collision happening between a historic global energy shock, deeply entrenched domestic inflation, and an incredibly dramatic leadership transition over at the U.S. Federal Reserve. This isn't just a bump in the road, it's a systemic paradigm shift. So today, we're going to break down exactly what is happening, why it's happening, and most importantly, how financial leaders and investors can actually survive it.
Okay, let's dive into this. Here is our roadmap for today. We'll start with the inflation reality check, move into the global energy shock, examine the showdown happening at the Fed, look at the resulting market contagion, and then we'll wrap the whole thing up with the new survival playbook.
All right, let's kick things off with Section 1, the inflation reality check. The economic reports that dropped in April 2026 delivered a truly punishing blow to financial markets, completely erasing any lingering hopes for a smooth, easy glide path. Just look at this number. 6%. That is the year-over-year surge in the Producer Price Index, or PPI. It's the fastest annual pace of wholesale inflation we've seen since December 2022. But, why does this matter so much to you? Well, because the PPI is essentially a massive wave of upstream pipeline costs. When raw materials and intermediate inputs get more expensive to manufacture, that cost becomes a tidal wave and it is rapidly moving straight toward the end consumer. It virtually guarantees that consumer prices are going to remain stubbornly elevated for months to come.
And when we look at the broader data here, the picture gets even more intense. Headline CPI hit 3.8% year over year, which is its highest rate since May 2023. But I really want you to look at that bottom row. Stage 1 intermediate demand. This is essentially the raw materials at the very earliest phase of the manufacturing process, and it surged by an incredible 8.9%. This totally confirms that the inflationary pipeline is rapidly filling up. And the immediate, really tragic consequence of all this broad inflation is what it does to the average worker. It has completely eroded nominal wage gains. In just a single month, real average hourly earnings plummeted by 0.5%. That's the sharpest single-month decline since the peak inflation days of 2022. Consumer purchasing power is actively contracting right now. So what's the spark? What is the catalyst driving all this pipeline inflation?
That brings us to Section 2, the global energy shock. This is essentially a severed artery. See, this isn't just a localized issue. It's a severed artery in the global economy caused by severe geopolitical conflict. Notice that massive 20% segment paralyzed right there. That represents the entire world's seaborne crude oil and liquefied natural gas trade. The ongoing military conflict and naval blockades in the Middle East have effectively closed the Strait of Hormuz, which is basically the central nervous system of global energy distribution. Now, under normal conditions, we'd see an average of about 70 vessel crossings a day through that choke point. Right now, that number has plummeted to just 2 to 5 ships a day. Just 2 to 5.
The cascading impacts of this bottleneck are absolutely staggering. The market is bleeding roughly 100 million barrels of oil supply every single week. This severe risk premium dropped Brent crude spiking past $111 per barrel. But guys, it goes way beyond the gas pump. Asian LNG spot prices have surged an astronomical 140%. Nearly 30% of the global fertilizer trade is just stranded out there, which actively threatens global food security. And perhaps most critically for businesses, even if the strait magically reopened today, there's a minimum 275-day maritime logistics backlog. 275 days! You could literally walk across the globe in the time it takes to get a shipping container through that backlog. This is forcing global manufacturers to entirely abandon the highly efficient globalized supply chains they've loved for the past decade and shift to super expensive, inefficient, local-for-local supply networks just to ensure their own operational survival.
Moving on to Section 3, the Federal Reserve Showdown, a true institutional crisis.
So precisely at this moment of maximal macroeconomic peril, right as inflation is surging and global supply chains are fracturing, the U.S. Central Bank is undergoing its most contentious and disruptive leadership transition in modern history. We are witnessing a stark ideological collision at the very top. On the left, we have the new Fed chair, Kevin Warsh. His mandate is explicitly framed as a hawkish regime change. He is fiercely dedicated to aggressive balance sheet reduction, basically transforming the Fed into a structural seller of assets, and he intends to completely eradicate forward guidance,
meaning no more predicting what the Fed's going to do next. On the right, we have his predecessor, Jerome Powell. Now, Powell's legacy was built on aggressive crisis management, utilizing quantitative easing, consensus, and vast liquidity to stabilize markets. But here's the unprecedented twist. In a massive break from a 78-year tradition, Powell has elected not to leave. He is remaining on the Federal Reserve Board of Governors until 2028, specifically to defend the institution's independence from political interference. This sets the stage for a deeply volatile dual leadership dynamic at the exact moment the economy desperately needs a steady hand.
Which leads us perfectly into Section 4, market contagion and the massive repricing of risk.
When you combine 6% producer inflation, a historic energy shock, and a volatile Fed showdown, what do you get? You get a violent, systemic repricing of risk across absolutely all asset classes. Wall Street has completely thrown in the towel on the 2026 rate cut narrative. Coming into the year, markets were aggressively pricing in multiple rate cuts. But as this quote from Bank of America so bluntly puts it, core inflation is simply too high and moving up. The solid April jobs report was the last straw. The fantasy of a painless monetary normalization, yeah, that's over. We are now facing the grim, hard reality of a sustained, restrictive monetary environment. And this brilliantly illustrates the panic. Major banks have entirely walked back their forecasts. Bank of America pushed their first rate cut expectation all the way out to July 2027. Morgan Stanley is saying early 2027. And JP Morgan? They hold a draconian view that not only are there zero cuts coming in 2026, but the next move might actually need to be a rate hike just to contain the energy shock. In response to all this, the bond market violently repriced, with the benchmark 10-year Treasury yield surging past 4.63%.
So we're now seeing the introduction of what markets are calling the Warsh premium. Because Warsh intends to aggressively sell off the Fed's balance sheet, yields are pushing higher, and that fundamentally alters the risk profile across basically all sectors. This soaring discount rate mechanically collapses enterprise software valuations. Why? Because high-growth tech relies heavily on future cash flows, and those are simply worth much less today. But even more alarming, it is exposing massive stress fractures in the $1.8 trillion private credit market. Middle market borrowers dealing with floating rate debt are hitting a brick wall. We're seeing default rates climb, like Apollo MFIC hitting 5.3%, which has actually forced major asset managers like KKR and BlackRock to activate redemption gates just to halt unprecedented investor capital flight. It's a mess.
Finally, let's get into Section 5, the new survival playbook. Time for the new rules of the game.
The entire financial playbook has changed. So, how do CFOs, allocators, and investors actually defend themselves in this environment? Well, the old 60-40 portfolio rules that thrived during 15 years of cheap money, they are structurally unsuited for this stagflationary era. Here are the new rules of the game. First, you must avoid long-duration bond exposure, because rising yields will inflict severe capital losses. Instead, embrace the short end of the yield curve with 0 to 3-month T-bills. In credit, you have to ruthlessly prioritize investment grade over high yield to avoid that impending private credit default cycle we just talked about. You also need to overweight real assets. We're talking commodities, gold, and energy infrastructure to actively hedge against that massive maritime logistics shock. In the stock market, shift immediately to high-quality, defensive equities that possess the absolute pricing power required to pass these costs on to consumers. And fundamentally, businesses must finance the transition to local-for-local supply networks. Value creation in 2026 is no longer about leveraging cheap debt. It demands rigorous operational improvement, margin defense, and incredibly robust cash generation.
We are living through a true systemic paradigm shift. The era of the Fed put and infinite forward guidance is effectively over. So as we wrap up this explainer today, I want to leave you with a really crucial question to reflect on regarding your own capital allocation strategy. Knowing what you know now about the energy shock, the Fed's hawkish transition, and these deeply sticky pipeline costs, how is your portfolio or business positioned to actually survive the 6.0% inflation reality?